Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at 4 undervalued dividend-paying companies you can pick up on the market right now. So as we all know, 2022 was a very tough year for the stock market, and the S&P 500 saw its worst calendar year performance since back in 2008. The market lost 20% of its value over the past year, and there's a ton of very strong dividend-paying companies that are now considered to be undervalued at their current level after the recent decline in share price. So in this episode, we're going to go over 4 different companies who each operate in very different segments of the market. We have a utility company, a REIT, a healthcare company, and a communication giant that are all considered to be undervalued at their current prices according to Morningstar. And for each of these companies, we're going to take a look at their current operations, some of their financials, and their future expected growth. So please hit that like button and subscribe if you're interested in dividend investing content. I'm the Gen Z investor, and on this channel we talk about the stock market, go over any major market news, and we track the progress of my personal dividend portfolio that now has a value of $174,000. So please hit that like button and subscribe. And now we're going to move on to the first undervalued dividend paying company for the video, and that is ticker MDT for Medtronic. This is a medical device company that currently trades for $81 per share. During the past year, they've fallen around 24% and are sitting on the low end of the 52-week range with a forward PE ratio of 15 and an above average starting yield at 3.36%. The company has a market cap right around $105 billion, and of course, if we take a look at their Morningstar report, the estimated fair value per share is at $97 per share, so with the company trading right around 80, they're expected to be sitting at an 18% discount from their estimated fair value, so you can pick up a company right now that's considered close to 20% undervalued with a nice 3.36% starting yield. If we take a look at Medtronic's latest quarterly earnings, the company generated $7.58 billion of total top-line revenue, representing 2.2% organic sales growth. And this revenue comes in from their 4 main business segments: cardiovascular, neuroscience, medical surgery, and diabetes. So Medtronic's not solely reliant on only one category of the business in order to grow. They have 4 main revenue drivers that they continue to innovate with new products for each and every quarter. And if we take a look at their pipeline, they have so many products that have just come out and have just recently launched. They have a ton coming out over the next few quarters and many more in the mid to long-term pipeline. And in the past 12 months, the company got approval for 180 new healthcare products that will be soon hitting the market. So overall, going forward, they have a ton of new goods that consumers and healthcare organizations are going to be purchasing, leading to sustained and long-term revenue generation and growing cash flow. If we take a look at their capital allocation, we can see they do a great job of reinvesting back in their business with $2.7 billion spent in organic research and development during the last fiscal year. They also own a minority stake in over 75 companies where they've invested over $900 million, and they made 9 acquisitions since fiscal year 2021, worth around $3.3 billion in total consideration for these 9 companies. And of course, they do return a ton of capital to their shareholders each and every year. They've been growing their dividend for 45 consecutive years, and they grew their dividend by 8% last year. So of course, they are an S&P 500 dividend aristocrat, and they're very soon to be becoming a dividend king over the next 5 years when they hit that 50-year streak. They also repurchased a ton of their shares, buying back a total of $5.5 billion during the past fiscal year. So overall, Medtronic does a great job of returning capital to their shareholders while also reinvesting back in their business. Over the long term, they see slow and consistent revenue growth, with their cash flow from their operating activities trending upwards at around a CAGR of 5% over the long term as well. And if we take a look at their share count, we can see a consistent decline over the past 6 years, quarter after quarter, as they continue to return that capital back to their prized investors. And taking a look at the dividend, we can see a yield of 3.36% right now. They pay $2.72 per share per year with a very safe and sustainable pay ratio of 49% of their earnings, giving them a ton of room to continue to grow that dividend going forward with a 5-year dividend CAGR of 8%. And if we take a look at their dividend safety score, it comes in with the highest rating possible of 99 from Simply Safe Dividends. So it's highly unlikely we see this dividend getting cut anytime soon, and with the company's payout ratio being sustainable, the consistent and growing cash flow and revenue streams for their business, I think this dividend will be very safe for many years going forward. So Medtronic was the first undervalued dividend company we're going to take a look at in this episode, and it's the first stock definitely doing some research into for your own portfolio that generates growing passive income each and every year. So now if we continue on into stock number 2, that is ticker DLR for Digital Realty Trust. The company currently trades for $106 per share, and this is a REIT that operates data centers all around the world. During the past 12 months, the share price is now down 31%. They're trading with a price to FFO ratio of 15.6, with a very nice starting yield at 4.75% and a current market cap just above $30 billion. So this company operates a nice high starting yield, and the estimated fair value per share is all the way up at $142, meaning they're trading at a 26% discount from their estimated fair value. So DLR is one of the market's leading data center REITs. They operate in 50 cities all around the world and have over 300 data center locations. They're the 8th largest publicly traded REIT on the market, and this company continues to pay out a growing dividend to their shareholders quarter after quarter. And if we take a look at the customers that generate a majority of their revenue, these are all massive names. These are companies that are not going anywhere anytime soon. And as all of these companies continue to grow, so will the data center needs they have, and that will lead to growing revenue for DLR. So of course we can see Meta, LinkedIn, Oracle, IBM, Verizon, AT&T, JP Morgan Chase, amongst many other big players in the tech industry. They're always going to have a growing demand for data storage and memory needs all around the world. So this company generates around half of their annual recurring revenue from their top 20 customers. And what we can see right now is that these top 20 are very strong, very sustainable, and will continue to have the demand for data centers for long into the future, of course leading to consistent revenue growth for Digital Realty Trust. And we can see over the past decade, their historical bookings have continued to reach quarter after quarter new highs. And in 2022, 3 of their 4 quarters set all-time highs for the company. And now if we jump over to their income statement, we can see total revenue continues to expand following the trend of total bookings from $2.4 billion back in 2017, all the way up to over $4.5 billion in the trailing 12 months with no signs of slowing down. And if we take a look at their dividend history, this company has been a major dividend compounder with a dividend growth rate over the past 17 years of 10% annually. From 2005 through 2022, we can see their annual dividends absolutely exploded from only $1 per share per year back in 2005, all the way up to $4.88 per share per year in the trailing 12 months. So this company continues to grow their dividend at a rapid rate, and I do believe they're going to continue to pay out that growing dividend for long into the future. And their dividend safety score comes in at a rate of 94. The dividend is considered very safe, highly unlikely to be cut anytime soon, so you can pick up a very high yielder with a yield right now 4.5% that is considered very safe and also highly undervalued with Digital Realty Trust at this current point in time. So DLR is stock number 2, and now if we continue right into the third company for the video, that is ticker VZ for Verizon. They currently trade for $40 per share, and the company has fallen 25% on the 1-year chart. They have a forward PE ratio of 7.7 with a current very high dividend yield of 6.53%. And taking a look at the Morningstar report, their estimated fair value per share is at $53.68, meaning Verizon currently trades at a 25% discount from their estimated fair value. And over the past few quarters, Verizon has shared some pretty good results, and the CEO has come out and said they're going to have a promising growth over the next few years. Taking a look, the company has shown positive subscriber growth over the latest quarter, with the CEO expecting that's going to continue over the next 2 to 3 years. And because the company has invested so much in capital expenditures during the past 2 years for 5G infrastructure, they now have a plan to cut or slash their capital spending by 23% in 2024. And over the next year, the CEO's priority is on cash generation and growing revenue per user, which is exactly what us investors want to see. And with Verizon, because of 5G, they spent tens of billions of dollars investing in 5G infrastructure. But now they've actually achieved everything they've wanted to achieve. In the latest article from the CEO, they're not slashing capital expenditure just to do it. They're slashing it because they've achieved everything they've been budgeting for, and they do not need to spend that additional capital in order to build out their infrastructure. And now they're going to reap the rewards of the spending by increased revenue and cash flow per user based on the 5G networks they've built out. And if we take a look at their latest quarterly performance, their largest segment of their business, the consumer segment, which generated $25.8 billion in the quarter, grew 10.8% year over year, which is exactly like we want to see. So for a slow-growing company like Verizon that does not expand rapidly over time, to see their largest segment of their business still post double-digit revenue growth is very exciting for potential investors. And if we take a look at their cash flow summary, exactly like I mentioned, $28.8 billion of cash flow from their operations, but they invested $15.8 billion in capital expenditures. This company will always have high capital expenditures just due to the nature of their business, but these are overall inflated due to the excess spending on 5G, and like we can see in the prior year, $13.9 billion spent on capital expenditures, leaving around $12.4 billion of free cash flow during this past year. They paid around $8.1 billion of that out in the form of a dividend, and the rest was used to reduce debt, like we see now down a few $billion compared to the prior year as well. So overall, Verizon now believes that this capital expenditure number will decrease significantly in 2023, 2024, and 2025, leading to excess free cash flow, and more cash on hand can lead to an increased dividend, while it gives the company more flexibility to pay down their debt going forward. And of course, if we take a look at that income statement, slow and continuous growth year over year to a record high of $135 billion of total revenue in the trailing 12 months. And if we take a look at their dividend scorecard, a nice high yield of 6.5%. They pay out $2.61 per share per year, with a very safe payout ratio of 48% of their earnings, a 5-year dividend CAGR of 2%, and taking a look at the dividend safety score, coming in at an 87, the dividend is considered very safe and will not be cut anytime soon. So if you're looking for some high current cash flow into your portfolio right now, Verizon is definitely a company worth taking a look at. And now we're going to move on to the fourth and final company we're going to take a look at in this episode, and that is ticker D for Dominion Energy. They currently trade for $62 per share, and over the past 12 months they have fallen by 21%, and we can see a majority of that decline has happened during the past 3 months. Their 4P ratio comes in at a 15, they have a nice high dividend yield at 4.28%, with a market cap just above $51 billion. And if we take a look at their Morningstar report, they have an estimated fair value of $73 per share, meaning they're trading at a 15% discount at this current point in time. And if we jump over to their investor presentation, this is one of the market's leading regulated utilities. They operate in 5 main states, and 90% of their utility business comes from these regulated utilities, meaning they're going to have consistent and growing cash flow into their business for many years going forward. I love regulated utilities. Of course, they're not going to grow at an astounding rate, but they have very predictable and growing cash flow over the long term, with customers who are pretty much forced to use their services. And if we take a look from their latest investor presentation, they believe they can grow their EPS by an average of 6.4% each and every year through 2026, combine that with a yield at 3.3%, which is actually higher if you buy in today, and they're projecting annual dividend growth per share at 6% through 2026 as well. So they're averaging around a 10% total shareholder return from a pure play state regulated utility operation. So overall, they believe they can return the double digits overall in the form of dividend growth and of course EPS growth to their shareholders all the way through 2026, which is exactly what you want to see from a pretty stable holding in your portfolio that you're pretty much using to generate that growing passive income. And if we take a look at their financial statements, they generate consistent and growing revenue slowly over the long term, with a new high of over $16 billion in the trailing 12 months. But if we take a look at their cash flow from their operations, over the long term, their cash flow continues to grow at a CAGR of 6.18%, which is exactly like we want to see. This company will continue to raise prices over the long term. They have contracts set in place that will continue to grow with inflation, so they're going to make more and more money as time goes on, with their customers, like I mentioned, pretty much forced to use their services, which is exactly the type of company you want to invest in for consistent and growing cash flow. And if we take a look at that dividend, we can see the yield is at 4.28%. They pay out $2.67 per share per year, a very reasonable pay ratio at 65% of their earnings, and the company comes with a safe dividend with a dividend safety score of 80. This company did cut their dividend just last year, but that's not because of their financial struggles. They cut the dividend because they sold out a majority or a large part of their business. They sold their natural gas division to Warren Buffett's company Berkshire Hathaway in a $9.7 billion deal, and this division generated 25% of Dominion Energy's operating earnings. So when you sell out of that part of your business that generates 25% of your operating income, you won't be able to afford the same dividend. So of course, some investors may treat this as a normal dividend cut. I look at this as a little bit different because they didn't just cut their dividend because their current operations couldn't sustain that cash flow. They cut their dividend because they sold out a portion of their business. It didn't really fit their core growth strategy going forward, so they sold it off for a profit. And of course, that's why they reduced the dividend. But like we saw from their investor presentation, they do plan to increase it at a rate of minimum of 6% going forward over the next 5 years, which is great to see. So Dominion Energy was the fourth and final undervalued dividend paying company we're going to take a look at in this episode. This stock, as well as the other 3 went over, all currently trading below their estimated fair value according to Morningstar. So if you're looking to buy in for a dividend payer that's expected to grow their dividend going forward, all 4 of the companies paid out a safe dividend, and they're all considered to be undervalued or cheap at this current point in time. So we're going to wrap up the video here, so please hit that like button and subscribe if you enjoyed the content, and I will see you in the next video.